Hello, I'm Dwayne Bishop. I'm the CFO Director for GPL Tax and Accounting, and I'm here to talk to you today about the additional guidance released by the Treasury Department that gives more explanation about how self-employed individuals and partnerships can take advantage of the Paycheck Protection Program. This video is going to build upon the information that we presented last week in our video about the PPP for businesses with employees. So if you're not familiar with the basics of the program, you might want to stop and watch that video before continuing with this one. So if you recall from the last video, one of the unanswered questions that we had about the program was how it related to partners in a partnership. And we did get some answers to this question in this new guidance. Now, what they did say is that they do not want the individual partners to submit their own PPP application as if they were a self-employed individual. Instead, the partnership itself, the business, should submit a single PPP application and include the partner's K-1 income as part of their calculation of their monthly average payroll costs. Now, a partner's K-1 can contain a lot of different information, and partnerships come in all shapes and sizes with different rules and membership and percentages, and further guidance is going to be needed before we know exactly how to apply this in all situations. But for now, we know that the individual partners should not be filing for a loan as a self-employed individual. So what we did get a lot of guidance about in this issuance is for Schedule C filers. So these are self-employed individuals who report their business income on their personal return on their 1040 on the Schedule C. Now, if you're using that form and you were in operation on February 15th of 2020, you are eligible to apply for this program. Now, to prove that you were in operation at that time, a 2019 Schedule C return plus some bank statements or invoices from February of this year to show that you were still in business would probably be sufficient. Now, you do not have to have already filed your 2019 return. If you haven't prepared it and submitted it yet, that's okay. But in order to submit the application, you will need to fill out the schedule as if it was ready to be filed. And if you did not have any profit in 2019, if you operated at a loss last year, then you will not be eligible for a loan and will not be able to benefit from the program. In the previous video, we explained how to calculate your monthly average payroll cost. Now, the guidance for Schedule C filers is very easy. If you did not have any employees last year and it's only your own compensation that's being replaced, you simply find your net profit from line 31 of your Schedule C, and that's your annual income from your business. You're going to divide that by 12 to get an average monthly income, and then multiply it times 2.5, and that's your loan amount. If you have employees as well as yourself, you're going to go through the same process as before to calculate your monthly average payroll, including health benefits and retirement benefits, state unemployment tax. Add that all up, add that to your net profit, divide that whole amount by 12, and multiply the result by 2.5, and that becomes your max loan amount. So the approved use of funds remain very similar to what they were before. You can use the money for payroll costs, for mortgage interest, for rent, and for utilities. But we got some guidance about what payroll costs mean for the Schedule C filers. They want you to replace your income for 8 weeks at the same rate that you earned it in 2019. So the math is very simple. You take the net income from line 31 of your Schedule C return from 2019, divide that by 52 this time to get the average income per week, and multiply that times 8. That is going to be your replacement income that you can use the funds for and that will be eligible for forgiveness. And we also learned that when they're talking about mortgage interest, that can include the interest on an auto loan. So if your business has purchased a vehicle for you to use as part of your regular business activities, the interest on that loan can be paid with these funds. As well, the gasoline and repairs on that vehicle can count as utilities that would be covered by this loan. Now, they don't want this to seem like it's a windfall for self-employed people, so they are requiring that 75% of the funds be used for payroll costs. So either payroll for your employees or your own owner compensation replacement. In regards to the amount eligible for forgiveness, we got some clear guidance there. The 8 weeks of owner's replacement income will be forgiven. It's a straightforward calculation. You take it from the last year's tax return, you pay itself again, it's going to be forgiven. But the rent and the mortgage interest and the utilities, the only costs that will be forgiven in those categories are costs that were represented on the 2019 Schedule C. So for instance, if you had a vehicle and reported that as a business expense in 2019, you can take that interest and gasoline costs. But if you didn't, you would not be able to have that amount forgiven for this year. So what you're able to do is very much constrained by what you report on that 2019 Schedule C. Only items that were present there will be eligible for forgiveness. So that's it. We got some great information about Schedule C filers and how they can apply for the program. But if you've been watching the news, you know that many banks are overwhelmed with the applications they already have and that it's challenging to get an application processed, and that the fund may be oversubscribed already by people who've already made the application. However, Congress is considering opening up more funds to the program, and new developments are expected. So stay tuned, and again, if you'd like help, please contact us at info@gplaccounting.com. Thank you.